In a market where there has been a sharp recovery across automobile segments post the opening up of the economy, and the frontline stocks have also touched their 52-week high levels, in our Ideas for Profit today, we'll discuss about one company from the auto ancillary space which has a strong business footing, has growth prospects, and is available at attractive valuations. Steel Strip Wheels is one of the leading designers, manufacturers and marketers of the steel wheel rims for passenger vehicles, the utility vehicles, even 2 and 3 wheelers, tractors, light and heavy commercial vehicles as well. Now, on the back of the strong product portfolio and also the execution capabilities, the company has established itself as one of the leading suppliers of the steel wheel rims across segments. Further, it also serves to the who's who of the industry. You talk about Tata Motors, M&M, Ashok Leyland, Daimler, Maruti, Kia Motors, Volkswagen, even BMW and Nissan are few of the names that it does serve over here. Now, steel rims have actually lost their market share in favor of the alloy wheels, especially in the passenger car and the two-wheeler segments of late. Now, steel strip wheels had quite an insignificant presence in the alloy wheel segment, and in the light of the growing alloy wheel market now, the company sees big opportunity as they actually generate 20% of the operating margin as compared to the 13 to 14% generated from the steel rims. Now, in light of this, the company has now forayed into this segment and also had actually set up a plant in Gujarat with an initial capacity of 1.5 million wheels. Now, alloy wheel segment contributed less than 7% of the total revenues if you talk about the entire FY20. Now, the management expects this segment to contribute close to 20% of the revenue over the next 2 to 3 years. In fact, alloy wheel sales have actually reached an all-time high in the month of October 2020, and Mehsana Alloy Wheels plant is operating at a 95% utilization. The company is now adding new capacity as well to meet the growing demand. Going forward from here, the demand, especially both in the passenger vehicles and two-wheeler segments, has quite recovered sharply after the lockdown restrictions were really relaxed. Also, what is really helping these segments is a shift in the preference towards the personal transport, as people still continue to be quite cautious about taking public vehicles currently due to COVID-19 pandemic. Now, further, the tractor segment also continues to do quite well, as most of the demand comes from the rural areas where also rains have been good. The rural India so far has been the least affected by the pandemic if you talk about it. Also, besides that, higher crop production has been there. There have been good crop prices. Farmers have received sufficient availability of water and even easy availability of finance are some of the factors that are expected to even augur well for the rural economy going forward from here. Now, concerns regarding the demand pickup in the commercial vehicles segment are also easing gradually. The impact of the overall recovery was also quite evident when you talk about the Q2 FY21 numbers of the company. The company has been targeting export markets also aggressively now. It has been receiving orders from Europe, UK and US. The company currently has a very strong order book from the export markets, and that is including the major BMW. The October 2020 export sales were also at an all-time high, registering a year-on-year growth of 121%. Now, another positive is the benefits that are accruing from a sourcing shift away from China. Major OEMs across the globe are now looking to reduce dependence away from Chinese suppliers. Now, the company has had a very healthy EBITDA margin, which averages around 12.7% over, say, FY16 to FY20. The debt to equity ratio, however, has remained on the higher side, which averages around 1.77 times over the same period. But what is really comforting is the strong free cash flow, FCF generation of about 200 crore rupees over the last 3 financial years, including FY20. Additionally, the sweating of assets at full utilization on the back of strong demand and higher margin due to increase in the share of business from the alloy wheels would definitely expedite the deleveraging from here on. Now, in terms of valuation, the company is trading at 9.2 times FY22 projected earnings, which is quite reasonable when you compare it to the average multiple of its peers as well. Now, the company is strongly placed currently and is definitely worth riding for the medium to long term for investors.